In our strategy, we use a 5-phase cycle framework. We're not predicting headlines. We're tracking signals, sequencing risk, and keeping optionality. This silver narrative sounds bullish, but the real question is, can you capture upside without dying by premiums and volatility? That's the entire episode. We're reviewing a video arguing silver in 2026 is a dangerous but lucrative setup. Go watch the original for full context. Our job is to translate the claims into our strategy rules. The video claims silver is shifting from precious metal to strategic industrial material. It also claims a multi-year deficit is tightening supply into 2026. Even if fundamentals are bullish, price rarely moves in a straight line. In our strategy, bullish fundamentals can still mean violent drawdowns. This is mostly an industrial demand and supply constraint narrative, with a microstructure angle, inventories, lease rates, curve shape. When industries fear shortage, they pre-buy. That can tighten deliverable supply and steepen volatility. Silver has negative carry. If real yields are high, your hurdle rate is higher, even before fees and storage. The video warns about paying 20 to 40% over spot for physical. In our strategy terms, that's starting the trade underwater. Premiums are a friction tax. When the story cools, premiums can compress faster than spot moves. The video mentions backwardation, spot pricing above futures. That can signal immediate tightness, but it can also be episodic. We want persistence, not a one-day print. If inventories trend down while curve tightness persists, that's confirmation. If inventories stabilize, we treat the squeeze story as less urgent. The video claims a future demand shock from solid-state batteries. Our strategy labels this as a high-impact, low-certainty catalyst until verified. This setup reads like Phase 1 to Phase 2 behavior in commodities. Upside participation is possible, but volatility and reversals are common. We don't need maximal exposure. We need clean structure, liquidity, low friction, and predefined trims. One sleeve for liquid price exposure, one sleeve for cash flow linked exposure, and one small sleeve for optionality, high risk, high dispersion. We don't chase spikes, we don't pay extreme premiums, and we don't size a single commodity to be make or break. Quick disclaimer. This is educational commentary about macro signals and risk management. It is not financial advice. If tightness confirms and demand signals firm up, upside probability rises, but we still express it through tranches and exits. If curve tightness fades and inventories rebuild, the urgency drops. Then silver becomes a tactical satellite, not a headline trade. Watch physical premium spreads, watch curve structure, watch inventory direction, watch real yields and the dollar regime. Predefine trims into spikes, keep dry powder, and separate industrial beta from hedge logic. We don't go all in. We don't average down without triggers. We don't confuse narratives with timing. This can be a real opportunity, but only if you treat structure as the strategy. We don't need to be early. We just can't afford to be late.